Hello everyone, this is my 2021 vision. It's my basically I'm outlining my future plans for the YouTube channel, what I'm using it for, and my 2021 investing strategy. I've been investing for the last 2 years. First year I was really just learning, reading, finding out how to invest, and last year I managed to make a return of 40% using a value strategy, but obviously investing in quality companies in the UK. I've managed to grow my portfolio to about £20,000, starting off with £100 2 years ago. I've invested about £12,000 into the portfolio since 2018, December 2018, to 13,000, and it's currently sitting at about £22,000. Now I'm going to be going through my strategy for this year and the YouTube channel and why I'm using the YouTube channel. So let's get started. Can I just put a disclaimer out there? This video does not constitute financial advice. I will not be recommending to buy or sell any companies, and the strategies used are for my own personal investment journey. Please seek professional and financial advice before investing, tailored to your own personal circumstances. I really just started this YouTube channel last year, about August last year, just to make a journal of my investments and share it with other people that are interested in investing, and hopefully, get some ideas and get a bit of in the comment sections of my investment journey and see what other people thought. So if I just ask you to do your own research before investing, really, I'm not recommending to buy or sell anything or telling you how to invest your money. So I'll pass that. The YouTube channel, it's Bargain Ninja Investors. Can I just ask you if you could all subscribe and hit the notification bell and like the video, please, to get the video, out there with the YouTube algorithm, so other people that are interested in investing and can see these videos. The YouTube channel is Bargain Ninja Investing. Obviously, the channel's had a refresh in 2021. What's new? It's new branding. It's now Bargain Ninja Investing. It used to be Focus Freshman Investing, but I was never going to keep that name. It was just something that's just something I come up with when I made the channel. As you can see there, I've got the new branding, the new logo. It looks like an angry ninja Pringle. Bargain Ninja Investing. And it's in the name. I'm looking for bargains in the stock market in quality companies. Obviously, we'll be doing it for a YouTube channel mainly. I've got an Instagram page, but I'm not sure what I'm going to be doing with that at the moment. I'm just advertising future videos on there. If you want to add it on Instagram so you can see what future videos are coming out at the moment, but I'm not sure what I'm going to be doing with that. Obviously, the content for the channel this year is going to be investment portfolio updates. It says monthly updates, but I'm hoping to be getting like a weekly one done at the moment, just to progress what I've brought, sold, what's gone up, what's gone down. Generally just a weekly series, and you can go on that journey with me throughout the whole year and see where my portfolio is going, my investment portfolio. Obviously, I'll be doing 2021 vision investment strategy videos like this one, quarterly hopefully. So one in January, one at the start of April, start of July, start of September, October time, and then finally one at the end of the year, or maybe the start of January, just to see how our progress has been in 2021 periodically. I'm obviously going to do stock watch list videos, and that's all the stocks that are in my watch list and the companies in my watch list that fit into my criteria of stocks that I'm looking at and in researching myself. And obviously I'll do more in-depth videos, company analysis videos, which I hope to be doing like weekly, maybe bi-weekly, of these companies and maybe a few other quality companies within the UK. And that series will be called Is Now the Time to Invest. I've already done a couple of videos on the Now is Now the Time to Invest with Greg's last year, and that since I've done them videos, I've made a 50% profit on that company alone. So it's worth having a look at. But obviously I'm still not advising. It's just how I do my analysis and how I value companies and how I understand the company. Obviously I'm on episode 6 at the moment of my investment portfolio journey. Episode 5 and 6 have been done this year in January 2021 under the new branding 2021. And that's really where I'm going to start this investment strategy from them two portfolios. I've outlined a little bit in them updates about how I'm going to invest, but not really gone into detail because of obviously this video. So that's going to be the content for this year. Maybe a few other things, but I haven't decided what other content I'm going to put up on here yet. So that's the content for the YouTube channel. The strategy, the investment strategy, is basically to invest in high quality UK growth companies with obviously good growth prospects at bargain ninja margin of safety prices. When I say margin of safety, I mean like if a company's valued at £1 million, I want to be buying it for 500,000, so half the price with the margin of safety in case, you know, things happen in life and I get it wrong. But also you're buying £10 notes for £5 basically, or $10 bills for $5, and doubling your money. You can compound your, and with growth added into that, you can compound your, you know, your money at a massive rate. I will be measuring my performance against the FTSE 100 and the FTSE 250 index, which are the main, and aim to outperform. I'm doing it against them indexes because obviously they're the UK market indexes, the two biggest UK indexes in the UK. And obviously I'll be investing mainly in I will in single stocks. I'll only be investing in UK stocks. So hopefully I'm going to outperform that this year. I've already, the last week, obviously you've seen a portfolio update episode 6 that I outperformed the market by about 10% for last week, which is a good start to the year. Well, it's a good start to the strategy. Obviously the companies I'll be investing in have got to be in my investable universe, which means my circle of competence, which means I have to understand them. So no biotech or, you know, some technology companies I wouldn't understand, so I'm not going to invest in them. They might be great, profitable growth companies, but I don't understand them, so I'm not capable of understanding them, so I'm not going to invest in them. You know, you should invest in what you know and what you understand. So obviously I've just cut it down to two main sectors: retail and finance. I understand quite well. And then obviously through them I've got athleisure wear, fast fashion, brands, franchises, online, fast food. And I understand all these and how these companies work and how they make profits and how they can, you know, increase profits. And then obviously on the other side of it, you've got brokerage firms, insurance, banks, online payments. So I'll invest in these companies if they fit my criteria in these sectors, because these are the companies I understand. If I don't understand them, I'm not going to invest in them because I'd just be speculating. Obviously, there are other sectors that maybe one day I might look into if I can got time to research them and understand them. But these are the main areas that I'll be looking to invest the bulk of my portfolio into. I'm only investing in companies I understand. I'm aiming to invest in things that I know well, and I use the products and services, and I have a working knowledge of it. So that's what I'm going to look to invest in my investable universe in 2021. The criteria for these quality companies and the characteristics of these quality companies. So once I've got, you know, my circle of competence, first circle of competence, my investable universe, I find the companies in them, and then I check out these criteria to see if they are quality companies. First one is high returns on invested capital, which basically means it's a calculation to assess if a company's efficiency at allocating the capital under its control to profitable investments, which basically means the return on invested capital gives a sense of how well a company is using its money to generate returns. So if it's using its money to invest in another, so if a company uses its money, like some of its profits, to invest into another venture, it's assessing how much money they make on that venture, in essence. Then the second one is obviously high returns on capital employed, which basically means it's a financial ratio that can be used in assessing a company's profitability and capital efficiency. In other words, the ratio can help to understand how well a company is generating its profits from its capital. So if it's got £100,000 sitting in the bank, how it can get that money working for it, employ that money to work for it, you know, make it. So if you've got a shop and it's thrown off 100 grand, £100,000 in profits, and free cash flow at the end of the year. If you've got that, well, you can buy another shop. And if that throws another 100,000, that's 200. That's basically, in a nutshell, assessing how it's return on capital employed. So how it uses its capital to increase its profits, generating more profits from capital. It's got to have an economic moat. This was coined by the Warren Buffett. Also, a circle of competence is coined by Warren Buffett. I'll call it the investable universe. But an economic moat is a term popularised by Warren Buffett. It means just the business's ability to a company or a business's ability to maintain competitive advantage over its competitors in order to protect its long-term profits and market share. Like something like Apple has a brand moat. Once you buy an Apple phone, you don't tend to buy anything else. You wait for the next one. It doesn't even, you could just have a slightly bigger button, slightly bigger screen. It's just small things. It's got a brand moat now. It doesn't need to be spectacularly different. You just stick with that. Same with cars. Sometimes they have brand moats. Sometimes you buy the same cars, same type of cars, same makes and models. There's also a switching moat. So like banks used to have really good switching moats until obviously you got a lot of switching. Now banks used to, once you've got a bank at 18, when you leave, when you start work, you'd keep that bank until your whole life basically. So that's a switching moat. And also with online brokerages and stuff like that, if you go with Hargreaves Lansdowne, you might not go to AJ Bell. People don't really switch as much as you might think. Obviously, you hear it in the news all the time that people are languishing in low interest paying savings accounts because the banks know you're not going to switch, and that's why they offer cash incentives to get you to switch. With people, for £100, some people still can't be, have the hassle of doing it. So that's a switching moat, and there was a lot of other different moats, and it just gives the company a competitive advantage over its peers. It's got to be cash rich, which means its cash position's got to be bigger. So how much cash it's got in the bank basically, and that's its free cash flow. And that free cash flow is basically, it just means how much cash it's got in the bank after cash outflows and to operations costs and maintaining its assets and stuff like that. Once all its outgoings are to take how much cash it's got free, and that needs to be growing every year. So if it's £100,000 one year, you want to increase the next year, and so on, because that's the measure of a business throwing off cash. All great quality businesses throw off gobs and gobs of cash, and that's how they grow the company over time. And they either invest the cash back in to increase the profits and generate more cash, or they pay it out to the shareholders as a dividend payment. But if without the cash, then you haven't really got a great business. High growth prospects. Obviously, you want a company that's got high growth prospects. You don't want it. You invest in a company for £4, it's going to be worth £4 in 10 years. It's pointless. And obviously that's measured by the PEG, and ideally below one. One's generally means it's priced good comparative to how much growth it's got. A PEG ratio is it's a valuation measure investors use, and it basically just evaluates how much the stock or the company's trading at comparative to its growth prospects, and a price earnings ratio. And then there's also the PE ratio, which I don't use because it just gives a fundamental indication of what investors are currently paying for stock relative to how much its earnings in the future. So if it's got a PE ratio of 10, you're paying 10 times earnings, so you're paying 10 years worth of earnings for the stock. But that doesn't take into consideration, so that generally you want the PE ratio to be low because that's when you find a company's valued low, but doesn't take into consideration growth. So the PEG is a measure that takes that growth into to consideration. So generally below 1 is ideal. It means it's priced quite well, and its growth is for its growth. Finally, a good story for the company, which means all these things that you talk about when you do research, you build a story on the company, and if you like the story and the values and where the company's going, then you'll invest in it, providing it has all these characteristics. But to be fair, sometimes a company can have all these great characteristics and still be too much money. You just have to wait for an event to happen or for it to go on sale, and that's when you pick up a Bargain Ninja investment at a margin of safety price. So this is how I'm going to implement my strategic implementation of my investment plan. I'm only going to invest in individual savings accounts. I may invest into pensions as well, but basically it's just for the tax shelter, because they're just basically ISAs just shelter your capital gains from taxation. So the biggest knock to compounding your money is being taxed. So if I make £10,000 on a stock, I don't want to be paying 20% tax or whatever the tax. I don't even know what the taxes are because I only invest in ISAs. I'm not a high earner, so £20,000 ISA allowance is plenty for me. I'm not going to be, I won't even be using that every year. So it's more than enough for me. If you're a higher earner, then you might want to put into a pension, and then once that's gone, then you have a fund and share account, which would be taxed. But you can offset your losses in that one, so just sell your losses and reinvest them into the ISA the following year, stuff like that. Bed and ISA it. But you've just if you don't need to pay tax, then don't pay tax. So I'm only going to be investing in an ISA this year, and maybe a personal pension, a SIP, self-invested SIP. I've got two types of ISA. I've got a normal ISA and a lifetime ISA. I use the lifetime ISA first because it gives me every £4,000 I put in, I'll get an extra £1,000, which is equivalent to 25% uplift. So I use that first, and then whatever's left over, I'll put into the stocks and shares ISA. Secondly, I'm going to be identifying, once I've got the accounts, I know what accounts I'm going to use, and then secondly, I'm going to be identifying the quality UK stocks in my investable universe to build up a watch list of stocks. And if they meet, and if they, I'll slimline that. Once I've got that watch list, I'll slimline it down to which companies meet my criteria, set out in the previously with all the quality fundamentals of the companies, and then I'll add them to a main watch list, and then obviously I'll watch them companies to make sure till they go on a decent sale price, whether a reasonable price or a bargain price. Hopefully a bargain price. I'll load the truck then. I'm going to do in-depth research into the companies in the watch list, and then I'll have every trading update, annual reports, earnings, any news on the company, any YouTube videos on the company, etc. I'll be doing my own research into them companies, and obviously I'll be sharing it with you on the YouTube channel in Is Now the Time to Invest series, and through my portfolio update series. I'm going to wait for companies to go on a Black Friday sale, like I just said, like in March 2020, and I'll load the truck, ensuring I have an adequate cash position of at least 25 to 30% of my portfolio to take advantage of low valuations. Now, if you've been watching the last two episodes, episode 5 and episode 6 of my portfolio update, you'll find that I've got quite a big 50% cash position, and nobody knows where the economy is going at the moment. COVID, the whole world's up in the air with it all. We're getting vaccinations out, but still nobody knows what the economic damage is. So it's good. I've got a little bit more at the moment to just, take advantage of. If there is another crash like last year, I've got a bit invested. I'm starting to build positions in quality companies. But if there's going to be a big crash, when it rains gold, I'm going to put out a bucket, not a thimble, as Warren Buffett said. Warren Buffett quote: "When it rains gold, put out a bucket, not a thimble." Because when everything's on sale, when it's at a low valuation, I'm going to want to invest as much money as I can for when it to go back up to where it should be. Because some of these companies are going to go on sale, and they do quite well. They've been doing quite well. But when the whole stock market tanks, it tends to even the quality companies go down. And if you can identify the quality companies that are still quality companies, nothing's changed about the businesses, nothing's changed about the story, the fundamentals are still the same. When their prices go down, you invest heavily, and then that's how I'm going to make my money. So all the time sitting in cash, you might think, oh, I'm losing out, not being invested in the market. But if I can identify quality companies and get them at bargain prices, when they go back up, all that time missed out in cash in the market will be made up in percentage earnings, as I proved last year, because I was sat in cash just before the crash, and then it flew up. I invested straight away. I started, I didn't put all my money in one go, but I started feeding it in. So as it goes lower and lower, I'd put a bit more in, and then I'll just let it go back up. Then took the roller coaster back up. Then I'm only going to sell my companies when the stories change or the value of the company is too overpriced. So if I buy a company that's, say its share price, for example, is I think it's £5, but then it goes down to 250, and I think that's a bargain, and I load the truck. If it then, over the course of a year, 2 years, goes up to 10, and then I think, it's still only worth £5, £6, £7, I'm going to sell the company, and that's like a four time, and that's going to that's already going to be like a, if you sell it at £10, that's four times your money. So you invest £5,000, that's £20,000. I'm gonna, so when it's overpriced, I might top slice some positions. So this is what I've been doing. So if I double my money, I'll just reduce my position. If I've got a big position, I'll just reduce it slowly until I've only got my profits in there. So then basically, my position in that company is just purely capital gain. It's not my initial capital that I put into the company, and then I can't lose my initial capital then. So also in essence, if I put £1,000 into a stock and it doubled in the space of a couple of months, 3, 4, 6 months, into £2,000. If I take the £1,000 out, I'm only sat with £1,000 capital gain, and then that helps me mentally. It helps me just run my profits and my winners. So because I don't feel like if the price goes back down, then I don't feel like I've got to sell, because I'll just add more to it. But I just feel like I can run the winner then, because I'm just playing with the house's money in effect. And then obviously once I've sold the companies that are overpriced, so I buy them cheap. After all, I buy quality growth stocks at a reasonable or cheap price, bargain price. Once I've identified them, and once they go on sale, wait for them to go up to a decent price or overpriced, sell them, and then wait again, sit in cash. Obviously, it'll be a cash position every time, and I'll be adding cash to the accounts as well. So, and then just rinse and repeat the process, and I'm going to see how I get on with this process. I'm still going to invest. I'm not going to wait. I'm not going to try and time the market. I'm not trying to time the market. I'm still going to invest. I'm just going to make sure I've got an adequate cash position to take advantage of any dips or corrections or even crashes in the market. I just don't want to be left, fully invested when it crashes. I'd rather just have, most investors want a decent sort of cash position. As my portfolio grows, the percentage of my portfolio in cash might go down. For instance, if I had £100,000 portfolio, I wouldn't want 25% in cash, because that 50% in cash, because that'd be 50 grand in cash. I wouldn't want to be sick. But obviously I've got a smaller portfolio at the moment, only 22,000. So that's why I've got a bigger percentage of cash, and as it grows, I'll have a smaller percentage. Because if I had £100,000, a 20% position in cash would be £20,000. It's still twice as much cash as I've got in my portfolio now. But as it is, I've only got a 20. So I've roughly got about £12,000 in cash at the moment, and I will be deploying it over as the year goes through. But obviously, I'm just looking to see what opportunities I've got. I think I've got about 6 holdings and a fund in my portfolio at the moment. But obviously, I'd just stay tuned and watching for these portfolio updates to see what I've got invested into these. So that's how I'm going to invest and strategically implement my investment plan for 2021. My goals for 2021 is to build positions in UK quality growth businesses within my ISA portfolios, and I'm going to provide, it says monthly, but hopefully provide regular updates on my progress and individual analysis videos on these quality companies on the channel. My long-term goal is to have financial freedom, become an ISA millionaire, and grow the channel to 1,000 subscribers. Now, I personally think it's going to be more challenging to grow this channel to 1,000 subscribers than it is to become an ISA millionaire. So with that, I'm just going to ask you all if you could subscribe and hit the notification button. Please like the video. Obviously, just to grow the channel and get it out there. The videos will get better. I'm improving with every video, I think, and I'm enjoying it, and I'm enjoying the journal side of it. So please, I'd like to share my journey with you, and hopefully, in episode of the portfolio, episode 493, I'll be saying, here's my £500,000 portfolio or £250,000 portfolio. So please hit the subscribe button, hit the notification bell for future updates on videos, and hit the like button to get the video shared out there. I hope you've all enjoyed this video. I look forward to getting some more portfolio update videos and more analysis videos out to you. I'll also be trying to do go through what's on my watch list and what companies I'm looking at for 2021. Hope you all have a good day. Peace out.